stay here. Firing off the short cannon. It's live, boys. Let's go. Let's go. Let's go. The interest rate decision is in 50 BPS, sending the dollar plummeting to new lows, stocks to all-time highs, and Bitcoin kind of unimpressively just like kind of near yesterday's highs. Bitcoin, you really got to get your shit together, man. I know you will. I have 100% confidence you'll get it together. I want you to have it together now. You just get it together for me right this moment. And look at this 4 hour. I like it. I like the 4 hour. Bear div on our highs, but market don't care. Doesn't seem to give a F. Let's do some low time frame stuff here quick. Let's see where that wick high went on the announcement. Wick high 1 minute after. Okay, there we go. Throw a fib on it. It's not really going to get us much info, but just throw a fib on it to keep an eye. I'm going to get rid of that. Oh, I can't wait for Chairman Powell to speak. I cannot wait. I haven't been this excited about Chairman Powell speaking in I don't even know how long. It's been quite some time. Moving this over. Let me check the feeds. Feeds are good. Everything is good. We're fully operational. AK, what's up, brother? Thanks for subscribing. Stephen Armstrong, Ultimate Alerts, Gang Gonjo, Dario, Lazjack. What's up, boys? What's up, my friends? Today is the biggest, most important FOMC. Oh, wait, the vertical one didn't go live. Hold up. There we go. Now you'll get the alert. Sorry about that. Little false flag here. Ooh, Spice continues. Spice is continuing. Oh, my. Bitcoin now retraced all of that announcement's gains right back to where it was. Let's mark this on our chart. Boom, right here. 60.2 being the initial candle of the announcement. Stocks faring better here. Dollar maybe looking for a little bounce. It would make sense to see a bounce. Maybe back to 100.8 and then fall again. You cannot update your video. Yes, you can. You can update my video, and you will update my video. All right, now the vertical is live. Nice. Nice. The mobile stream is live. The regular stream is live. We've got just about 20 minutes. Just about 20 minutes. Until Chairman Powell himself speaks. We did a lot of intro. Tom Powell joined us. Bitcoin, stocks, and the dollar reacting incredibly to the 50 BPS change. Probably the most bullish outcome. What do you guys think? I think I can change the votes. You guys voted like hell. I love it. Almost 5,000 votes on the main stream. 43% of us going with the 25 BPS, which was, I think, the logical choice here. Unfortunately, wrong. No cut, wrong. 75, wrong. 50 BPS, only 39% voted for it. Well done. Well done, fam. Did me proud. Let's end that poll. Holy bonkers. Go to the channel page, click the regular stream. That is right. If you're on the mobile stream, you can go to the channel page. You can join us on the main one. Where was I? Lost my train of thought. Bitcoin, though, retraced the gains it had made off of that candle. S&P 500 about halfway. Half of the gains. I think I did these fibs wrong. There we go. Deep retracement. A little bit more shallow retracement here on stocks. Dude, what is it? What is with these stocks rallying and Bitcoin just being like the kind of special cousin? You know what I mean? Like, hi guys, I'm here. I'm watching you have fun. I'm not. Mom says no, I'm not allowed to play with the other kids. What is with it? When are you gonna get your shit together, Bitcoin? This channel is now just gonna be me yelling at Bitcoin to get its shit together. It's gonna act like its mom. There we go. Chairman Powell speaks now on the chart in front of us. Show you guys quick too. If you're confused, if you're on a stream that you don't understand, just go to the channel page. You'll see 3.1 thousand people watching the mainstream. Got about 80 over on the mobile stream. Shout out to every single one of you. You're all G's. You're all the best. What's up, Flibbity Rabbit? NBKN. Oh, cool. All right. Nothing burger. How is it a nothing burger? This was the biggest, most nourishing meal we have had covering these in over a year. Not a nothing burger. Sorry, I'm just getting the the other chat up too, so I got both simultaneous. What's up, Tristan, Johnny C, Filthy Rabbit? I see you over there. Macus, it went down 50. Wait, what? Can you speak to the Bitcoin manager? Yes, please do. Put in a complaint for me. Nick Young says, smash the likes. You're a smart man. Because crypto is too much uncertainty. Putting your money into extra volatile crypto. Well, there's Bitcoin and then there's crypto. That's what I would say. Coca-Cola says, get wrecked. Was the stream unlisted? Yeah, it was. I just publiced it. That's why I didn't get it. Because Bitcoin is decentralized. I like these answers. Gold is flying. Thank you for the tip-off. Let's take a peek at gold. Likely the biggest winner. It was already at all-time highs. And now the dollar tanking here. Let's see. Gold added to the bottom. These charts are getting very tiny. Very, very tiny. Yeah, gold is faring the best. We had a new all-time high. We did hit one, but now sold back off in typical gold fashion. Gold really mirroring that weakness in the dollar. I can't stress it enough. It's not like the most exciting content, but like I cannot stress this enough. The dollar looks so crappy, man. In August, we broke December's low after lower highs here. Lower lows, lower highs, downtrending. The only support left since we hit like 114 in 2022. The only support left is at like 99.6. We're reaching down to there, man. You lose that, and where do you end up, right? Somewhere in the low 90s. Retested 90? I don't know. That's brutal. But gold really, really reflecting that. For gold, at least. All-time highs for gold and stocks. Bitcoin. Go to all-time highs so I can add you to that list. Reef USD nearish. I think I still have Reef pulled up. There you go. Reef stopped us out, lame. Going to 003. There you are. There you are. You don't see the regular stream, 100 Air. To tell you, buddy. Go to the channel page. I'll put the link in there, but you can't even click links on the short stream, so. Smash Toshi, 2.5 in November, 50 for December. You think, here's the next poll. Into the end of the year. 50 BPS cut in. Fire. How much BPS will we get into the end of the year? So not counting this. Not counting today. How much cuts will we get into the end of the year, do you guys think? So let's do like 25 BPS more, 50 BPS more. Let's go 75 BPS more. And we'll do like plus 100 BPS. Vote in the poll. Would Dodge hit $1 by tonight? No. Sorry, Rickson. What's up, J Stacks, Johnny CSE? Sean says 25. Thomas Kratochival says 50. Antithis says wait for the pump and dump to end. Go long, baby. I agree. I warned you guys. I don't think trading these is the way to go. Let me see. See what this is. See what we had here. There we go. The original FOMC projection here. I hope this is wrong. This is what we originally had plotted out. Interesting that price went almost exactly. Nah, it overshot it. Price overshot the arrow. This is typically what we see. I did say a few times today, if any FOMC is going to kick or not kind of follow the same mold that we have seen over the last, year of these, it's today. Today was the first interest rate cut since the hiking cycle started in 2022. We've been at peak rates for a year, an entire year. The last interest rate increase was in September of 2023. So we spent a year at peak rates. Here we are. I think today is the day that could kick this trend, do something new, kick off some new cycles. What do you guys think? Gold all-time highs, stock all-time highs, dollars eating poop. Just the way we like it. Gold again breaking all-time high. I'm just going to pull up a gold chart. Curse you, Peter Schiff. Curse you. Curse you. Interesting. We charted gold versus silver. Let's just say this quick. Gold versus silver last month hit the bottom of its range. Silver now in a bullish engulf. I'm looking for silver to go back up to what? May's highs here against gold. And that's an interesting setup because gold hitting all-time highs. Now at 2,600 today, still looking for a little more. Little bit more here if you zoom out on the gold chart, right? All the way back to the 80s. Get rid of all this rainbow snaz. There we go. Get rid of that. You can see that a little bit higher. It's about 2,650. Will bring us back to a trend line that goes all the way back to 1980, connects to 2011, and has been untested until what looks like this year. It looks like this year. We're going to test it. What happens there? I have two ideas. One, gold rejects from there. We see a big retracement, moves sideways, eventually crawls back up to all-time high. That's probably the likely outcome. The other outcome is maybe gold is going to become a much more volatile asset. I think that that will be suggested if gold breaks through our trend line, trades into the 2,700s, comes back to it, and breaks that high again. If gold has that setup, I think gold is going to behave differently into, maybe we'll say the end of the decade. I could see gold becoming a much more volatile asset that has more expansive upsides, bigger downsides. That's my 2 cents. That's my take. I'll play the Chairman Powell song here for a sec while I catch up on everybody's messages. I think super chats I missed. Watch your speakers. Money machine going bird. Chairman Powell. He ain't playing, this a blur. Gotta follow the data, ain't no time to air. Watch him speak now with that Tom Crown flair. Yeah, Chairman, he's the captain of the crew. Navigating through the markets, knowing what do you think? Federal reserves in control, making moves. Keeping that money flowing so the economy can groove. Chairman Powell, making paper every hour. Chairman Powell, he got that money power. Data on his side, watch him rise and devour. Yeah, he's the chairman of the board, making moves that empower. All right. Coming back up. This is what I'm watching more than anything. But Bitcoin goes up, goes down, stocks continue. Not as like interested right now. Right now, all eyes on the dollar, dude. That was a brutal drop. We have seen only maybe a handful of these drops on the dollar in 1 minute on the interest rate decision in a 60-second time frame. The dollar dropped 0.5%. It doesn't sound like a lot because a lot of us are kind of crypto people here. What do you mean 0.5%? For the dollar, that is wild. That is huge. We may not have even seen a candle like that on previous FOMCs. We've gotten some spicy ones, but just put this in perspective. On the 5-minute, look at this. Ready? Boom. It's like it got rugged. 15-minute, boom. This really looks like a crypto that got rugged, doesn't it? Just like trending, maybe higher lows, higher highs, straight down. Straight down to Valhalla. The dollar is, I might make another prediction, and this is a wild prediction for today. I think the dollar breaks 100. I think it goes to 99 something. Maybe Walter Powell speaking. As long as the dollar is moving down, I'm expecting to see stocks, gold, crypto move up, even if it sees some retracements. It's not just up. And that is so far playing out ish. Let's see. What's interesting, I was kind of criticizing Bitcoin here for a second, right? What's interesting is while I was criticizing Bitcoin because it had that nice green candle on the interest rate decision, retraced all of that gain, and I was saying, man, what the hell? Why is Bitcoin doing this? Stocks also did the same. Saw a rally to new all-time highs in the S&P, returned to exactly the point where it rallied from off that info. If we weren't looking at the dollar, I would say, man, maybe that isn't as bullish as we think, right? Maybe this isn't giving us what we want. But the dollar is saying, don't say that quite yet. Don't quite get on that mindset because I just broke to a lower low again after breaking a multi-year support. It's saying, don't count the spice out quite yet, my friends. You're short, Sony. F everyone. You're allowed to be short, bro. Did they announce the rates yet? Yes, they did. The dude, 50 BPS cut. That is more than I thought. Also, it is time for me to admit, guys, you know, I'm just a dude. I'm just sharing my thoughts, my analysis with you. I don't claim to always be right. Here's another one of those times where I was wrong. All throughout the year, I said, I don't think we're seeing interest rate cuts until after election at the earliest, but most likely in 2025. I'm going to own up to it. Yeah, I was wrong. Today, we got a 50 BPS cut with now very likely more cuts into the end of the year. I should have put 0 as an option, but I didn't. How much do you think that we will cut into the end of the year? I believe we have 2 more meetings. So if we did 25, 50 BPS, that would round us to an entire 100 BPS in the end of the year. Interesting. The rate at which we increased rates was so slow. It's 25 BPS, 25. And then we plateaued for a year. In September, we hit peak 5.33%. Today, in September, we cut 50. Slow up, fast down. Do you think that that will continue? Or do you think that that is just a one-off? What's up, Bad Baptist? You're a Chad, bro. 3% is the new 2%? I think so. I think that we will go. I think we're going to go to 3%. So I was doing analysis on this the other day, last night. I don't know why this doesn't work like it did. Maybe it was like the year, the 6 month. No. Got to use the regular chart. I was just looking at the previous cycle. That's not bad. All right, the 6 month, a little bit better. Using that fib got us to 5%. So I'm like trying to chart this. Is this a good idea to chart? Probably not. It's probably meaningless to chart, but hey, it's fun. It's fun. If we want to do really base analysis, just SR, right? We'll just say, okay, 2018, 2.5%. That was our resistance, right? That's where interest rates reached in January of 19 before, obviously, March, they undid everything really quickly. Maybe we'll see interest rates continue to drop till they reach 2.5%. What do you think about that? I think 2.53% is like the zone. I don't think, here's a bold take. I do not think that interest rates are going to go right back down to 0 like last time. I don't think that's what's going to happen. Provided we don't have a global catastrophe that shuts everything down, I don't think we see that happen again. I think what we'll likely see is consecutive cuts by the Fed over the next year that brings us down to maybe 2.5%. Maybe then we see a bounce. I don't know. But this is likely where the Fed wants to keep them. The reason being is if the Fed just cuts all the way down to 0 again, if we do have that disastrous event, they won't have anything to work with. They won't have the tools. And that's kind of the scenario that the Fed found themselves in going into COVID. They had begun cutting. COVID crashed everything, and they just put them to 0. And the problem was that they didn't have any more rates to cut as things got bad. They weren't willing to go into negative interest rates, etc. So I think they're going to keep them maybe closer to that 3% and then have a little wiggle room if something happens, right? Was it the year? One of these perfectly hit it. Here it was. All right, I showed you guys the 3 month in the beginning. I guess it was the year that I was looking at because I was like, one of these is perfect. Using our fib tool on the 1 year T-bill yield. Really spicy. Really spicy. Right up to that measured move. Exactly. Is the Fed doing TA on their interest rate changes? If they are, I'd have some tips for you. I have some tips. Depends what you want to do. Do you want to pump and dump these or do you want to keep them high? They probably want to keep them high. But right to the measured move. I believe it's 5.22. This is exact. Kind of spicy. Here's my advice on the Fed. If you want to manipulate your chart, here's what I would do. I would send rates back down to 0, okay? Maybe I would hold them at 0.5. Test this low again, right? And then here's what I would do. I would take my fib tool out. I would look up here and I would aim either for the 1618 or the 2. So then I would look over the next few years to increase interest rates to 8.2 or 10.25%. Might look something like this. So this is what they want to pump and dump it, right? There you go. Start making this upward trajectory. That's what I would do. Right here, Fed. Chairman Powell. There you go. You can take this. You can have it. It can be yours. You can just say you did it. There you are. The Fed's long-term decade plan to raise interest rates to 10%. All right, enough goofiness. We've got only a few minutes now, boys, before Chairman Powell is live. 2, 3 minutes? 3 minutes? The anticipation is palpable. 50 BPS cut kind of took some people by surprise, myself included. Chair Powell going to be joining us in a few minutes, and he's going to have to tell us why. Why did you keep saying things weren't where they were supposed to be? Things weren't where they were. We want this, we want data, we want whatever. Why? If you were just going to cut them in September by 50 BPS, why didn't you cut 25 last time? And then 25 today. He's got a lot to answer for. He will likely be sweating it. That's what I think. He'll be sweating it. Set up. Okay. We got the Fed's like copyrighted weird music that they play that I think got us demonetized once. There we are. Up in the corner. Just a few minutes away. Are you ready? If you're ready, smash the like button. Subscribe. The spice is just beginning. It's just begun. Let's see here. 2,000. Got about 2,500 or 2,800 viewers. Still on the main. Hopefully those numbers are going to climb into the Chair Powell. I want this to be the biggest FOMC. It is the biggest FOMC. Even if no one else shows up. We got the fam. Even if no one shows up, this is the biggest. Because something happened. They changed up their menu. Nothing burgers off the menu. Inflation took them off the menu. They got too expensive. Crypto face still here. Yo, where's he at? You like Chair Powell? Chair Powell. Yo, Mr. Steve. Chair Powell's great at his job. He's a great speaker. It's not his fault. The country's where it's at. Crypto face with the wisdoms, man. 100% agree. We can hate on Chair Powell. You know, hey, you didn't do what we want. You're not pumping our bags. The dude is the only person in all of like the political world, because he's not in politics, but the political world spectrum, that keeps it nonpartisan, that doesn't cater to like all of the BS people throw at him. I agree. I think he's great. He's also a celebrity. I see Steve. What's up, Steve from Optical Art? We have a lot of creators in this channel watching. Give Steve a subscribe. Great dude. Great analyst. Love him. Shout out, Steve. Shout out to you. He's on the spectrum. Everyone's on the spectrum. 20 seconds. 20 seconds. I'm going to refresh this. I'm going to just real quick reload. Are you ready? You ready? Steve is a great name. It's a great name. Let go. Are we going to drop before we pop? Oh, probably. Actually, honestly, this looks like we going to pop. We going to pop when we pop. We were looking for the downside, man. This was the spiciest interest rate in. Huge green candle on corn, on stocks. S&P went to a new all-time high. Both retraced all those gains. Now Bitcoin up a little bit from where it started. Up a little bit. The dollar taking the show here. The dollar eating absolute crap as Chair Powell joins us. Shh. Shh. Gina. Where's Gina? Gina. Oh, wow. Quiet. Yes, that's him. That's Chair Powell. The man himself. Ooh.
Good afternoon.
Good afternoon.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019.
Let's go Bitcoin.
The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
Steal a speech from
For
Tom
much of the
Powell.
past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so.
Go.
We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those
Higher highs,
least
let's
able
go.
to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished, and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Questions? Gina. Asian Gina, then back
Steve
to Asian
Leachman,
Gina.
CNBC. Thank you, Mr. Chairman, for taking our questions.
Shut up.
In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you weren't thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
Nailing them. Get them. Eat them.
So, okay, a lot of questions in there.
That was a lot of questions. It was. That was. Ha ha ha! It's a joke.
So, since the last meeting,
What color is this
the
tie?
last meeting, we have had a lot of data come in. We've had the two employment reports, July and
colorblind.
August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
So that was a question. Correct.
Sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know,
What if I'm
as
in a
I
rush,
mentioned in my
though?
remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
What if I want it now? When moon, please. Gina. Again,
Hi,
Gina.
Chris Rugaber at
You're not
Associated
Gina,
Press.
bro.
Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year.
Yeah.
So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%, inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment, moving to a more sustainable level. So that the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard?
Gina. Asian Gina, at least.
Howard Schneider with Reuters.
Wild
How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year?
Yeah, we're gonna take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina. Let Gina talk. No more Mangina. Let Gina talk.
Hi, Chair Powell. Gina Smilek with the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
Beautiful question from a beautiful lady.
Again, the labor market is actually in solid condition, and our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Answer her better. Look at,
Sorry, Nick.
answer, that was, we just got rugged again.
Nick
Everyone's
Timrose,
quiet,
Wall
they
Street
don't know
Journal.
what to do.
Chair Powell, does today's action
Chair
constitute
Powell.
a catch-up in action
Powell.
given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay.
Go back to Gina.
Multiple questions in there, but so I would say we don't think we're behind. We do not think we think this is timely, but I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably under 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace.
That's what everyone literally is going to do,
think
and you
about
know
it in
it.
terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
That's an interesting question. I didn't think of that.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market. But this is more sort of 2018, 17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, we're it bears watching, and we're watching.
It
And
bears
just
watching.
on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate, and as you know, we're not seeing rising claims, we're not seeing rising layoffs, we're not seeing that, and we're not hearing that from companies, that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
The totality of no data.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be
there is no
watching
data. Great
all of
question.
the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So, and policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's
in the room
action
with us right now
as a sign of our strong commitment to achieve that goal.
Oh no, it's not here. It's not here. Asian dude.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've
No,
mentioned a
'cause
couple,
there isn't
but
any.
would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person as measured. It's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, that could go on and on. There are many, many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change, particularly over the last few months. And so what we say is, as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. Or no, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of
We'll take the
look
data.
at the incoming data and,
We'll put
and
it
ask
together.
what are the implications of that data for the
take it apart.
evolving outlook and the
then
balance of
we'll
risks.
look at it,
and then
turn
go
it
through
a
our
little
process
bit.
and think what's the right thing to do.
And we'll
Is
think about
policy
it.
where we want it to be
This is the
to
Fed.
foster the achievement of our goals over time? So that's what it
Then
is,
we're gonna-
and that's what we'll be
We're
doing.
gonna make a wish on the data. Only if we see a shooting star.
Hi, Chair Powell. Neil Irwin with Action.
By the way, this just in, the dual mandate is now a dual mandate, and Chair Powell is forced to fight to the death with me after this speech.
Do you view that level of job
Apparently.
creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed the unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes, so we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it.
He's rambling today.
So that further declines in job openings will translate more directly into unemployment.
A little bit rambly.
It's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
So the next interest rate decision will be settled by a one-on-one as the
Thanks, Chair
rules
Powell.
of the
Edward
dual
Lawrence,
mandate
Fox Business.
require.
So we've heard some speculation that
Lots
you may be
going on.
going with the federal funds rate to 3.5, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
And one more, how do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so this is my fourth presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And, it's something we all take very, very seriously.
Yes,
we don't
very,
put
very
up any
serious.
other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene.
Love you, Mr. 100. Thank you, man.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
Looking.
I would just say
Better
that,
than ever.
the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not.
Fine.
So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not doing, we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
I'm encouraged by Asian Gina.
Katerina.
Very encouraged.
Hi,
I'll just go
Katerina
back to
Saraiva
Gina.
with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but the direction of travel is clear, and as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
So the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Let's go.
Hi,
Let's
Victoria
go.
Guido with
Subject
Politico.
matter.
Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So
Not actually,
I think,
fine, but basically,
I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look, when at this meeting we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we literally everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Broad.
Elizabeth. Thank you, Chair Powell. Elizabeth Schulze with
Chair
ABC
Powell, drink.
News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com.
Real quick here, Bitcoin holding on to a little bit of his gains since the interest rate decision came in. Stocks now, this is interesting, stocks now below where they opened. I was talking about, oh man, stocks holding up better. Guess not. Breaking below the traded value, now coming back up, testing that as resistance. The dollar, oh, that's gold. The dollar almost back to where it started as well. Even though this went for like a little different trajectory, kind of the same trading pattern coming here, where we get a move in one direction that reverses and we end up pretty close to where we started.
Could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? You know, after the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that.
He sounds very nervous.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
That's what we'll do. We'll do what we think we should do, and that's what we'll do. He's getting tired, dude. He's like,
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
He's tired. He's like trying to keep his eyes open. It's like
Matt Egan from
being
CNN.
sleeping right here.
I know that you discussed earlier how the Fed does whatever the right thing is and nothing else
And
factors
with
in.
no
But
details
in
at all,
general,
just that
can
you
you talk
do.
about whether or not you believe a sitting U.S. president should
Oh,
have
no.
a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope, and strongly believe that it will, continue.
Chair Powell, do you need a nap right now? Are your naps related to the interest
American
rate
Banker.
cuts?
Thanks for taking the questions, Chair Powell.
Chair Powell,
couple
drink.
regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, hold it.
Let me. We'll give you the
He's
second
like,
question.
I'm too tired for more than one question.
The answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about.
I'm going to propose to Asian
and then
Gina
take
and
comment
Gina at
on
the
them.
same time.
So yes, that is
Three-way marriage.
that's happening with my support.
Don't really surprise.
Date for that.
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday there were merger reform finalizations from the other bank regulators.
Hipster Frodo.
What does the Fed have
Oh,
to do
God,
to
that's
align
savage.
itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today.
Here, Barr said 50 was too much yesterday. Last question, Asian Gina and Gina
Chair Powell,
again.
Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage. So very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Oh, you're committed.
Vulnerable to a shock now that could tip it into recession.
I don't think so. I don't. As I look. Well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn, is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
Thank you.
Okay. Thank you, Sleepy Chirpow. That was the biggest, most explosive FOMC of our lives. Wow. So let's recap here. 50 BPS in. Surprising me, surprising many. We did get an interest rate cut. That's the first one since we hit peak interest rates back in September of last year. So exactly a year ago. On the announcement, at exactly 2 o'clock, we saw some very spicy price action. Bitcoin and stocks rallied hard. S&P 500 hit all-time highs. However, at that time then, Bitcoin and stocks went all the way back to where they started on that rally. The dollar maybe maybe having the biggest shakeup here. The dollar dumping 0.5% in 60 seconds. Huge move for the dollar, breaking down multiple multi-month year lows here. Now back to where it started. We say this every FOMC. This one did play out a little different, but it looks like it's coming in and fixing that at the end here. The dollar, big old dump back to where it began. This is going to be the point to watch as we see it happening right now, 100.87. If the dollar continues past this mark, the day has just begun on the spice. Wow, there it is, literally just seconds after Chairman Powell ends his speech. With the weakness of the dollar in a bigger macro picture, I can't help but be bullish on stocks and Bitcoin, surprising my audience. Oh my God, Tom Crown's bullish. Can't say I really expected this like price action though. Bitcoin really in the last second just testing that open. Now maybe opening to a red candle. S&P 500 really battling it out here. 50 BPS was supposed to be good for risk assets. It was supposed to be good for markets. I wouldn't take, I don't know, it's been like an hour. I wouldn't take an hour after this announcement and be like, that definitely wasn't or was good as an outcome. This is something we're going to see evolve over the next few days, weeks, and even months as the Fed has committed, obviously, to more interest rate cuts coming in the future. This is a hell of a stream. A lot of the time we hype these up and maybe they aren't as interesting. But this time, this is the first nothing burger that we haven't been served. The first missed nothing burger. This was a something burger. But I will say the last thought here, the questions and even Chairman Powell's energy. Wow, the dollar passed where it started. Really 180 the whole thing. It was very exciting. And man, that monotone, no data, we're going with the data, really drove the energy in the other direction. I was like falling asleep during that. The audio was terrible. I could barely hear it, so I was doing my best. What's up, Jedi Master? Jedi Master Ham. Nice. Subscribing. Man. A lot of thoughts, a lot of stuff going to unravel, I would say, in this week. We got Thursday and Friday ahead of us, and things are getting very spicy. The last thing I kind of expected is for nothing to happen, though things did happen. The dollar broke really critical support. The S&P 500 hit all-time highs. I guess what I want to say is I really was hoping Bitcoin would do something. I was really hoping Bitcoin would do something spicy. Apparently not. Apparently that's not in the cards. Maybe that's going to be coming up later today. I don't know, man. I appreciate everyone from tuning in. We'll be covering, obviously, the next FOMC, where they'll have another interest rate cut. It might not be the biggest ever next time, but we might call it that anyway. You guys rock. We've had I don't know, close to 1,000 new subscribers during this live stream. You can see those numbers still rolling over. 126,700. All we need is 2 more. Great stream. Thank you. I tried. If you missed the intro of the stream, Tom Powell did visit us, did give us a little speech, prepped us on what was ahead. God, I love that guy. So smart. Chairman Powell, keep looking for that data, bud. You'll find it. Asian Gina. Okay, this is the last update. Asian Gina looked immaculate. Immaculate. Asian Gina. Whoo. Gives me the vapors. Gives me the vapors, I'll tell you. Anyway, we will be live again on Friday at 1 p.m. East. We're live here Monday, Wednesday, Friday, 1 p.m. East, and any time Chairman Powell speaking basically in between. We'll be hitting that analysis hard on Friday. So I hope you join us. Jump in the Discord, discord.gg/Tom Crown. Join our community for the goodies, for the best 24-hour live chat, crypto nerdin', chart nerdin'. Join us. Discord, I'm trying to copy and paste it. Discord.gg/Tom Crown. Sign up with any of the links in the video description below. They are affiliate links, however. Sign up with them, and you will get exclusive VIP access to our private trading group in Discord for free. Check out our sponsors, LuxAlgo and Meta Signals. And boys and gals, that's all we got today. Thank you for joining. I love you all. I'll see you Friday, hopefully to some green candles.